presentation on the first ever and most robust, I would like to say, self-funded searcher study done by the Search Investment Group. This will be a debrief with Robert and Jordan, who I've had before on, and I'm always delighted to have them. And I am going to say just welcome back with such great information. While folks are coming in, I am first going to mute the sound so you don't have to hear it. And while they are coming in, I will do a few announcements, and then there's so much great information. I'm going to turn it over to Robert and Jordan. So just a couple of announcements here. The first is that open enrollment for the Nuts and Bolts program will be closing on January 27th. So if you are considering the program, please apply today and get the process rolling. The Nuts and Bolts program is a workshop that I created based on all of the interviews, everything that I read, all of the meetups that I've had. What I'm trying to do with this is to save searchers some time and trouble in gaining traction on launching their search. I've talked to operators and CEOs about what they wish they'd had thought about. I've talked to successful searchers and current searchers about their needs and wants and what they wish they had known starting out. And I've put that chock full of information into 18 hours of programming in a global cohort-based workshop. So if you are interested, please see me or apply or come to our Q&A session, which is next week. So speaking of events, there are some good events coming up. One which I am not sponsoring, but I thought was really relevant is the Equity Structures and Self-Funded SBA Acquisitions, which is sponsored by Live Oak Bank. So they're going to have their experts and specialists there to answer your questions. The Q&A session, as I mentioned, for the Nuts and Bolts program. And next month, we're going to have Jane Kagwa Snow. She was the first woman of African descent in the search fund space, the first traditional searcher. I basically glommed onto her when I became the second woman of African descent to be in the search fund space. So a delightful person. I found that few women know about her. And so I'm really excited to have her as part of our Women in Search Happy Hour. It's a great part of the history of search funds. She was also the first searcher to embark on searching in Africa. She ended up taking that and converting it into a startup. And so that's a fascinating story as well. And now I hear about searchers launching in Africa all the time, and it's a growing community. The next session, I have them a little out of date order, is easing the headaches of getting your capital contributions. There's a lot of uh, technology that's expensive for those startups that have angel round investors and have venture capital investment. It's a little bit harder for small and medium-sized business investors to do it, and entrepreneurs, and Veravand is going to try to fill that space. So we're going to have a showcase with them. I'm also seeing a lot of questions on holdco strategy. It's definitely an increasing thought among searchers globally, not just in the United States. And there will be an Ask Me Anything with a Chenmark on that topic. And I will be hosting additional ones. I took a bit of a hiatus and decided to focus on writing the book for the Nuts and Bolts program. But now that I'm getting to the waiting end of it, I'm looking forward to basically ramping up on our sessions and getting more folks like Robert and Jordan in for discussions on timely topics. So I want to say first, thank you again, Robert and Jordan, for being here. I'm going to turn off the my side of the presentation, stop the share. So Robert and Jordan are both were self-funded searchers, so they know the pain that you are going through. They both acquired, and they both, I don't know how you're doing it with everything that you do with Search Investment Group, but they both run their businesses. So Jordan heads up BA Group and Robert heads up Pillar Health. So welcome and thank you for what you've done with this study. It's incredible.
Yeah. So Karen, do you want us to go ahead and go through some of the key observations we had? We also love
Yes,
to.
please. And then of course I have questions for you as well.
That sounds great. We
Yeah.
definitely want to, as many questions as people want to ask. It was a great undertaking, but hopefully worth it to the community, and just the beginning of the future endeavors as well. So I felt in many ways, Robert and Aaron and Wesley and I, we all felt in many ways that kind of it's our responsibility, right? We spend a lot of time in this space. It's our passion, and we have access to unique resources, and so it's our job to also make increase awareness, increase insight to help other people out. So
I'll say, yeah. Sorry, Jordan, didn't mean to interrupt you. Go ahead.
yeah.
So, for the traditional search space, there's been the Stanford study, which has been something that's done regularly for years. And it's been a real benefit to those pursuing the traditional search path. As you know, Karen, there really hasn't been anything like that on the self-funded side. The self-funded space has kind of been this black box. Everyone just, we've got ideas of what's in that box, but no one had, really objective data on it. And so we, made a pretty big effort here to try to gather as much data, a comprehensive data set on this path to entrepreneurship. And we spent months and months on it, honestly. So the effort really started last summer. And then we went through, the survey process, and then the data, analysis and cleanup, and then the production of the report, all of which, just finished just a few weeks ago here. So we're really excited about it. It's data that's never before been available to this on this community, for this community. And hopefully it's helpful to folks who are thinking about doing this. So yeah, excited that we were able to get out there and kind of be the first to do this, and we think it'll be a resource for years to come. This is, as Jordan kind of pointed to, the first iteration of many reports. So just right off the bat, we'll put an asterisk on it and say this is not perfect. Right, the data here isn't perfect. The methods used were not perfect, but this is the first time this has been done, and we tried to use the best methods we could. And end of the day, decided that it was better to release this information as it is than not release it. And I think given the task, we did a really good job. So excited to talk to you about it today.
Yeah, so with that, I think we can go through some of the top findings, some of the best insights that we felt were either confirmatory, but it's nice to have data behind it, or surprising. So I can, I'll go first, and then Robert, I'd love to. Why don't you just go for another one as well?
Sure.
So to me, I think the biggest thing, if I'm going to just take something away here, I know self-funded search is a broad space, right? You can, a self-funded search could be a company that's very small, that's going to be, essentially buying a job and coming into that company. And yet we've also been a part of and observed people buying companies with $4, $5, and $6 million of EBITDA. So to me, some of the insights here are, what are people actually seeing when they're getting up close and personal with acquisitions and completing them? So to me, there's something quite special about getting to the, kind of between a $1 to $2.5 million EBITDA deal. Let's see if we can get that in here. To, what was it, acquisition multiples, kind of towards the end here. It's a lot in here.
Well, page 38 would be a good one, Jordan.
38.
Page 38. Yeah, you can see that 83% of searchers acquired under 5x. That's pretty amazing. And I talk to folks who, some folks I think have the impression that the market is too efficient and that there aren't good deals out there anymore, or that prices have gone up too high. And, I think that this shows there still are great deals out there, right? Because the vast majority of folks are acquiring companies at, pretty reasonable multiples.
Yeah, so there's that aspect to it. The revenue of the acquired targets, of course, we have here, and out of we polled over 1,000 people to get insight. We reached out, we asked for for their responses across a range of platforms, LinkedIn, Search Funder, and Twitter, and really try to do it in an objective manner and just see what the data was going to give us. And I think it was close to about 300 people that were able to come back with non-duplicative, clean data sets. And of those, there's many that are still searching, and there's a subset that actually successfully acquired their own business. So there's there's a little bit of both datas here. I will say that the average time that the respondents on average were spending in their search, inclusive of those who had acquired, was actually within the past 3 years, and so it's relatively young data. I think that's probably reflective of the fact that what was used for finding these people was our personal connections, people that we know well, and our, I guess you could say, age bracket is relatively young. I bought my company about 2.5 years ago, and Robert bought his about 3.5 years ago. So it's still on the younger side, but I think that will continue to get more longer duration as we continue to do this periodically. But yeah, the fact that you can still come in here, approximately 83% of self-funded searchers acquired at less than 5 times EBITDA, and they were acquiring sizable businesses too. I mean, if you just look at this top chart here, certainly there's absolutely a chunk that's, let's say, below 750,000 of EBITDA, but look at all the other spread between 750,000 all the way above $2.5 million. So that was pretty, I think, meaningful to me.
Yep. So meaningful thing to me as well. If you go to page 33, So if you go to page 33, the vast majority of searchers actually close within 18 months if they close. So that's pretty neat, and that's regardless of the sourcing strategy they use. So I say to people who are thinking about searching, make sure you've got 18, 24 months of cost of living expenses saved up, probably 24 because you want to be safe. Make sure you've got enough to cover your due diligence costs. But it's going to probably take you a while to find a company, but not too long. So if you're going to acquire a company, it's probably going to be under 1.5 years. And, when you get to the point of, you're 6 months in, you haven't found a good prospect, don't get too discouraged, because there are a lot of people who are acquiring later on in their search. And when you get to the point of, you're 1.5 years, 2 years in, and you haven't acquired a company, that also is a good time to step back, reevaluate the way you're searching, and think about maybe how you can adapt your methods, because clearly the majority of folks who are acquiring in under 1.5 years. So if your process is not yielding that result, then you probably need to make some adjustments. But in any case, it's pretty, I think, it's a pretty positive finding here that the vast majority are acquiring in under 1.5 years.
Yeah, that's a good point. And the another thing here is just how you're setting up your search. For the people that acquired, right? So that's when you see in the question here, it says acquired only. So it basically, in the survey, it essentially started branching off once you said you did acquire a company. It asked you the follow-up questions. And 65% of those acquisitions were made via a generalist search, which I think is something that everyone always is trying to figure out, is should I focus on maybe an industry from my past, or should I just try to be opportunistic? And I think that's what that's essentially saying here is being open to taking a look at a good business, and is helpful to being able to get you into a company. Now, I mean, I did a generalist search, and I ended up buying a company that I had no idea I was going to end up in local government facing services in an industry I had never worked in. But the company and the industry matched a lot of things that were really on my target list. If you think about having an investment criteria checklist, I personally believe that's more important than necessarily saying, well, I don't have experience in that industry before. The better question should be to ask, can I build experience in the industry? How long would it take for me to get up to speed to be at least minimally effective as a leader? This goes back to where your focus on a size of company really does matter, because if you're buying something that's a little smaller, it's going to have more weight on you to actually roll up your sleeves and participate in the production of the revenue at some level. And the larger companies you get, of course, a perfect example being, let's say a large company CEO or a public market CEO, that's not their job. Their job is more, meetings and forming partnerships and designing initiatives. And I think as you get up towards that end of the spectrum, really it becomes less relevant about what necessarily technically which is often the reason people want to focus on an industry, and more so about, is it a good industry? Is it a good business? Does it align with, let's say, as a self-funded person, what geography you actually want to be in and could see yourself living in over a long term if you need be. So I think that's this is all often pretty helpful for people when they're setting up their search.
One big misconception about self-funded search is that folks who are doing it can only buy small Main Street businesses. And as you can see from the report, that's just not the case. People are buying larger businesses. And we've had, anecdotally, the experience in SIG of searchers buying 3-4 million EBITDA companies with the self-funded model. And if you look on page 38, 46% of the searchers who acquired in the study acquired a company with over $1 million of EBITDA. So I think that's a misconception, clearly, that is shown here. And if you skip ahead, I want to talk about one other thing that I think a lot of folks really are worried about, dead deal costs or transaction costs, and they feel like they don't have enough savings to do this. Well, this report does a really good job of trying to encapsulate what those costs are probably going to look like. So if you go to page 40 and 41, what you can see there is most searchers actually spend $20K or less for a Q of E and $40K or less for legal fees. So these are not, humongous fees like you typically see a private equity firm pay, in terms of due diligence and transaction costs. Usually they're actually pretty reasonable. People are working with, attorneys and accounting firms that are professionalized yet reasonable cost. So I think that's one thing here that is important for folks considering doing this. And then if you go over to page 42, what you'll see is dead deal expenses, right? Where you spend a bunch of money to do due diligence on a company and then the deal didn't close. That's what a dead deal expense is. Well, 75% of searchers who closed deals spent less than 25K on deals that didn't close. So that's really not, that's a doable thing for most people searching, right? It's not as terrible as I think some people think, that they think they're gonna, spend $300,000 on on legal fees and then the deal's gonna blow up and they're stuck with the legal fees. Well, the majority of searchers don't end up in that position. So I think that's important as well. Folks shouldn't be probably quite as concerned about those items as they are.
So that being said, this is a probability game, right? Search generally, you want to give yourself the maximal, probability to be successfully closing a deal. That's your first win. But, secondly, that you bought a great business from a great seller in a great industry, and that you can prove yourself as well once you step into that role that this really is a good fit for you. So doing all that work up front, But absolutely, having enough, I mean, you look on, even on this page, there's a chance you could end up having to spend over 50,000 on dead deal fees. And is that going to kill your search? So, for me in my search, I'll just tell you real quickly that I had a 401k that had been built up from working in New York in investment banking and private equity. I essentially made it all available. It to me was liquidatable and ready to be spent, because I was going to go to the ends of the earth to make sure I successfully bought a company, whatever that took. I know that there are searchers who do spend over that on dead deal fees, and this goes back to having a good investment process. When you think about yourself as a kind of a one person private equity buyer, if you will, there's a reason private equity firms have processes. They have investment committees. They have checklists that even that disqualify way more companies than end up across the finish line or even get an LOI. So that being said, it should be encouraging that you don't have to spend a ton of money, and that you can structure it in a way that that hopefully is not too burdensome, but having enough to be able to contribute to the deal in the case that you need to, and having enough to be able to live another day after you something happens. I mean, for me in my search, I had 3 deals that essentially busted, and all 3 of them, it was for reasons that were pretty much out of my control. One of them, for example, a seller just decided last minute that he just didn't want to sell, and just emailed me in the middle of the night and said, I've really thought about it, and I'd like to continue running the business. So what are you going to do? Right. I mean, you just got to keep moving. Yeah. What else we got? Robert, you want to cover another one?
Sure. One big takeaway for me was how much ownership searchers are usually walking away with. So, if a searcher uses a preferred equity model, which is, that is the most common equity model utilized in self-funded search, according to the study, then they are generally retaining very large ownership stakes. So if you look on page 57, 86% of searchers that utilize the preferred equity structure retain over 60% ownership of their company. Pretty amazing to see. So this is definitely, proven out here in this study, a true path to owning a majority of a small company. So it was really great to see that. Another really positive takeaway from the study for me was how positive the relationships are with sellers post-closing, which honestly, surprised me. Anecdotally, we had a lot of issues with our seller post-closing over a few tax issues. And when I saw the study result here on page 61, I was surprised. But it's a good type of surprise, right? Because only 13% of searchers who closed deals had negative relationships with the seller. Great to see. That's I felt like a really positive finding that was included here.
Yeah, that's a great point. So, one of the things that's least talked about in search, so everybody can look at a model, everyone can think about, oh, I want to buy in this, EBITDA range, or I like this type of industry, and, I want to manage these types of employees, or, live in this area. And those are kind of things that you can start out with, and you can pretty much figure out in an afternoon. But where you really get tested in search many times, and we go back to the dead deal expenses, some things are out of your control, some things are in your control, but assessing these sellers' integrity is one of the most difficult things to do during your search, and yet I believe is very impactful to not just your relationship with the seller, but also how great of a company you ended up getting, and or how many kind of things were not exactly disclosed pre-purchase that either could severely impact the company and the ability for you to be able to perform as a leader and as a manager and an owner, or they could dramatically support it. And I found, anecdotally in my case, that if anything, the seller almost undersold the opportunity. Really, I mean, there was just a really high level of integrity. I'm in the very positive category. I consider the seller to be an extension of my family, if you will. I feel like I just took over a business from, interfamily, which is kind of one of the best scenarios you can end up with. But and you never know too. Some of the businesses that ended up going to the wayside, maybe I got lucky. Who knows? But in the moment, it certainly didn't feel that way. I will tell you, anybody who's been through it. So, and you go back to the the search duration. Robert, you were talking about within 18 months, people have by and large been able to close deals. I think there is something to that. You get off the ground and ask any searcher from start, and then ask them at 6 months how much more they know or how much more humbled they got once they got past the first 6 months. And they'll share with you that it's a totally different world once you're 6 months in, especially if you're doing it full time. You learn quickly that this is a very competitive space, and there's relatively few businesses that truly are worth transacting, worth changing hands, worth what the seller wants for the business, and also match the the attributes that I think are necessary to give yourself a chance to be able to do well here. So, okay. Anything else, Robert? Do you want to go to cover any other charts or findings?
Yeah, I think last one for me, last takeaway. If you can go to page 35, Jordan, that'd be really helpful. I think where a lot of folks get into trouble, and this is actually also addresses one of the questions that's been submitted, where folks get in a lot of trouble is when they are not submitting enough LOIs on good businesses, or they are submitting an LOI and then not searching after they submit their LOI. And some interesting things we found here, right? For folks who acquired a business, they submitted on average almost 7 LOIs in total. And of those 7, almost 2.5, a little less than 2.5 actually got executed. And then of those, the vast majority of searchers in the study ended up closing, one deal. So, what you find here is just getting a deal under LOI doesn't mean you're going to close the deal. And you're probably going to need to submit multiple LOIs and also execute multiple LOIs to get a deal over the finish line. So, takeaway for searchers here, don't be too shy to submit LOIs on good businesses. And as fast as you can get to the point of being able to submit an LOI confidently on a good business, once a month, call it, that's where you want to be. Where you've got good enough deal flow and enough confidence to know what a good deal looks like, and making sure you're submitting enough LOIs, because it takes a few times at bat before you knock it out of the park here. So that's what I'd say there. And also don't stop searching once you get a deal under LOI, because the chances that your deal that you just got under LOI actually closes is actually not that high.
Yeah. That's a good point. One other thing here on the sourcing side of it, this really goes back to, here's what this chart's telling me, right? 48% of the the source of finding the target that the searchers responded with came from direct intermediary outreach, and direct intermediary outreach being actually engaging with that person, email, phone. You can automate emails, you can send out blast emails, but ultimately kind of establishing that connection and them being able to share the deal with you is far and away the plurality here of where the target came from. So anecdotally, my deal was direct intermediary outreach. It was not from a deal aggregator website or kind of one of the like biz buy sell type places. It didn't come through. I didn't have a buy side advisor. They're kind of expensive. They cost money on a retainer basis. So I was doing self-funded search, just pure, and established relationships with brokers. That's where my deal came from. The other thing is right here. So we have essentially leverage, correlation with, size of business, and far and away, you can get, quite a bit of debt to fund your acquisition, all the way up to, you look at the size range up here, to around, 1 to 2 million, and even 2 million plus. 2 million plus is when the chart starts to kind of shift, right? Where you see that you're just not able to get as much debt, compared to the other brackets, and that leading to starts to become a little bit of a fall off in a purchase price multiple able to be achieved. But ultimately, kind of, you look at this, and there's, I think in the study we're finding that you can actually still get a pretty decent amount of debt on your business, that you're looking at, even at some of the larger size companies. So back to that concept of there's just this like sweet spot between $1 and $2.5 million of EBITDA that you can end up getting a good amount of debt on the business, which enables you to raise investor equity and get it on some of the best terms you possibly can, to enable you to keep as much common equity as possible. So that should be very encouraging to people as they're thinking about how they want to scope their search. So with that, Karen, I'd love to open it up if you have any questions, and we're happy to field it.
And we do have questions in the chat. I actually have a question. I wanted to talk about a little bit about the time to acquisition, because anecdotally, I always felt like there was a good chunk of searchers that were able to acquire quickly, but the data that you have actually indicates that it's really a substantial number, right? I think you're averaging about 20 something percent within 6 months, and then 50 to 60% within a year, which is, I think, incredible number. Uh, you know, what do you think is driving that based on the data that you have? Do you think that's because there's so many targeted searches? What's driving that?
I don't know exactly. I can tell you anecdotally, I closed within a year, and there are quite a few searchers that have worked with SIG that have. Well, I think every searcher that's worked with SIG has closed within 12 months. So I think it's not as uncommon as folks might think. So especially if you look at the different ways, while I said that. It doesn't really matter the method that you search, you're probably going to close within 18 months. The majority of self-funded searchers are sourcing their companies through brokered searches. And a company that's being represented by a broker is most likely going to be in a position to transact faster than a non-brokered company, I think, is generally true. And so given that a majority of searchers are using the brokered network, they're probably getting financials faster. They're probably getting tax returns faster. They're probably, looking at companies that are prepped to sell and with a seller who's ready to go, more so than, if you think about, I think even on the traditional side, and I don't have statistics to back this up, but I believe this is the case. I think the majority of deals, or a very large percentage anyway, come from the proprietary method. And on the proprietary method, you've got deals where, an owner may not even be thinking about selling right when the initial contact happens. And you can see that a little bit here on page 33, right? It does generally take a little bit longer on the proprietary side. So, if you think about for example, on the traditional side, which I think a lot of people are more familiar with, especially at some of the top MBA programs and in some of the conversations that happen in our industry, their search probably does take on average a little longer than self-funded, just because of the channel that they're going through. That's my theory.
So
Yeah.
you talked a bit about the sourcing piece of it. and I had a similar conversation. So in the prior session with the Search Fund Coalition, we were talking about deal sourcing. And one of the questions that came up is, based on this data, uh, would you be more, I guess, prescriptive with a new searcher and say, look, the way to go is really direct outreach and getting to know brokers rather than going proprietary?
My advice to a searcher that was working with us would be to probably have a very heavy focus on brokered search. I think that proprietary search can be a nice complement to that. So I wouldn't write it off completely, because clearly you can see from the data here, people on the self-funded side are closing deals using proprietary search. They're also closing deals, through their network, right? And so, it may not even, the deal may not even necessarily come through a transaction intermediary. I think it's the page prior to this one, Jordan, page 31. Yeah. So, or the one before this one, sorry, page 30, Jordan. Yeah. So, only 50% of the deals are coming through a transaction intermediary. There still is a 25% chunk in proprietary outreach, and then, network and other types of intermediaries. And when we say other types of intermediaries, we mean non-transaction intermediaries, like, financial advisors, attorneys, things like that. So, I think a balanced approach with probably a heavier focus on brokered outreach makes sense.
And I had one question I'm not sure you'll be able to answer. Some searchers will do an IOI to an LOI. Other searchers will do just the LOI. And for folks who are new, the IOI is basically a softer version of the letter of intent. It's sort of an indication of interest. It's a way of getting a document to a potential seller saying that you're interested, but there's no real commitment. Were you able to distinguish between the two, or is that all lumped into the data that you have?
We did not collect information on IOIs. We just collected information on LOIs. And I'll just say anecdotally, a lot of the transactions we're involved in do not use an IOI. Some do, certainly. The more formal transactions, right, where you've got certain due dates of certain things, and a formal management meeting, time frame, things like that. You do see that, but in a pretty large percentage of the deals that we're involved in, anecdotally, there's just we just go straight to LOI. We just collected data on LOI submissions.
Karen, here's what I feel about that. So, to that point, formal IOI versus really talking with that intermediary or seller and saying, hey, I'm in this range, or this is where I feel like I could, as long as things worked out and everything looks good, I could do this number. A lot of searchers get really hung up on that aspect because they don't want to reveal their cards too soon, or they don't want to share a number that's that maybe it's too low. They're maybe pricing in a lot of things that they think are probably true, but they don't know are true. That's what makes this whole thing kind of tough, right? And there's less information on on deals in this space than there are, of course, in in middle market private equity. You just don't have as much of much information before you're able to send across a letter of intent. So as we just shared, we do encourage kind of moving faster. If you can, just go ahead and try to get a sense of where that seller is really looking, for what price they're looking for, and then moving as fast as you can to trying to go under exclusivity. Because at the end of the day, you're going to learn a lot more under LOI, but what's even crazier is you're going to learn a lot more after you actually buy the company that you will never have access to, or never be able to even get, because the data doesn't even exist. So taking a big step back, reframing your entire thought process when you're coming into search, and accepting the fact that you're just not going to have a very granular level of information or detail that's going to enable you to make very confident decisions is one of the things that you really learn after your first 6 to 12 months, and you start to kind of reframe that and accept it, and then move a little bit faster. I hope that's helpful.
That is very, very helpful. So we do have questions in the chat that I'd like to get to. I have a couple more that I want to ask, but I want to do the chat first. Ali asks, in your experience for self-funded search deals that close at the 5x EBITDA or less, do you have a sense for typical historical revenue growth rates of the targets?
So like matching up the the businesses that were bought for less than 5 times EBITDA, what were those revenue growth rates?
Yes.
Yeah, my
That's
question
kind of
is
the
if self-funded searchers tend to skew towards slower growing businesses, which maybe is why they are able to purchase them at more attractive prices. The Stanford study 2022, I think it's like the median was like 6.5 times EBITDA for similarly sized businesses. So maybe funded searchers just like paying more, or maybe they're buying faster growing businesses.
I think that's generally a reasonable, approach to it. I know that there's been a heavier weighting that into software businesses that are of course being purchased at much, higher multiples, and on the other end of the spectrum, something that's more of a service business inherently hasn't had as fast a growth is going to have, is not going to be able to command that kind of purchase multiple. So we've seen it, personally, just seen businesses that historically have been, let's say, more stable. You can get them for cheaper for sure, and ones that have had successful growth rates. I've personally assisted help searchers and business they got for less than 5 times had a historical 10 to 15% revenue growth rate. So it's not that it doesn't exist, it's that you're, depending on a range of other factors, you have a higher probability of having to pay up for that business. So that's my view on it. Robert, what do you think?
Well, these deals are, I would say, on average, on average, right? If you looked at the 80% middle of the histogram here, they are smaller than traditional deals, right? As a group. So that's probably part of the driver of, the lower multiple, and whether that's a reflection of lower growth rates, we can't say for sure. We did not collect data on historical growth rates of the companies here, but that's something we might include in the next iteration. So I appreciate you bringing it up because it's a good question.
And Ali, do you want to ask your second question for them to answer?
Sure, and Robert, I think you might hit on this a little bit, but the question was just for self-funded searchers who take longer than 18 months to close or don't close at all. If there are typical reasons you see or areas where they could have improved to improve the probability that they close.
Yeah, I saw that question and I liked the question. I can only answer that anecdotally because this isn't data we collected. But from our anecdotal experience here, I would say that searchers who do not submit enough LOIs and don't get a good deal flow going and a good rhythm to understand and a good understanding of what a good deal looks like and the confidence to be able to submit those LOIs on good businesses when they do have that deal flow, that's where they really, I think, get into trouble. Because if you're not gonna shoot the ball and try to shoot the ball in the hoop, right, you're not gonna you're not gonna get the ball through the hoop. So you got to shoot the ball. And so you got to submit LOIs. And the other thing here is once you do get an LOI submitted, that doesn't necessarily mean you're going to close a deal, right? So keep searching. And I tell searchers that we work with that once they get into under LOI, 50% of their day they spend working on that deal, and the other 50% of the day just pretend you don't have a deal to work on and spend it just like you didn't sign an LOI. Go find another business that's a good acquisition opportunity. That'd be my piece of advice there, and where I see searchers running into the most trouble.
So another thing here that has to be considered is when you look at the Stanford study on traditional search fund success and metrics, every single one of those people is full-time searching, every one of them, right? You look at this self-funded study, we have a mix, right? There's some part-timers, there's some full-timers. I think what should be encouraging is that even with that kind of mixed data, that people are tending to get their deals closed in relatively short time periods. That being said, I would guess that somebody who's part-time is going to be on the longer end of that thing, because I did a part-time search for a year, and I look back and I completely wasted the year. That's my perspective on it, right? I think you're just not giving yourself the opportunity when you're already short-staffed. You're one person. Doesn't matter if you have 20 interns. You have one person. You're one person, and you're the one who has to get on the calls with the sellers, the brokers, form relationships, build those kind of that flywheel, and that's what ultimately yields success in the kind of dead center of your search.
Thank you.
Yeah, great question.
So the next question is refers to two of your figures. Derek asked, can you comment on targeted versus EBITDA ranges? The targeted range from figure 7 skews higher than the closed on figure 21, though there are different populations. Do you
Yep.
have a sense of what they would look like for only those who had actually closed a deal?
It's a great question. I saw it earlier. We did not filter the data like that, but that would be interesting to see. So we might have to, think about doing that after this and see if there's something there that we might, release. But good question. Don't know the answer to that. Looks like folks, we can't really compare the two populations, and we're not really drawing any conclusions around around that, because one issue with the study we talk about actually at the end is, and this is an issue with the data, collection method here that we're, obviously, transparent about discussing, is the amount of people searching. We can't draw too many inferences between the amount of people searching and the amount of people closing between those two. Because we don't have good definitions around close rates on those who are searching. The group of the population that's searching is very fluid, which is unlike traditional search, where you have like a very defined population of people who are doing traditional search. And in this space, we found people who were searching, but we don't know what percent of those closed, for example, what percent of them, the thing is that population changes all the time. So we're not drawing any success, related inferences there because we can't well define that population, unfortunately. We're working on that, but in this iteration, we weren't able to do it. But I think both things probably for a future study. Good question.
Yeah, to me, what's encouraging about that is that you're seeing just from that, I'll share it here, this figure that was being referenced, that the targeting is kind of, the targeted EBITDA is like skewing or going a little bit higher. And I think it's encouraging. That means that people that are, presently searching are, hopefully it's what that's meaning, is that people are realizing that they can actually go after something larger. They're not limited to what's in their checking account. And I think that's hopefully super encouraging. There are several lenders out there that do not care if you personally put cash into your own deal, because they know that you took an opportunity cost by even doing the search. And so you essentially invested with sweat. Same thing for raising equity. So we helped somebody in February of last year get $3 million of equity on a $4 million EBITDA deal, and he put in nothing. Absolutely, he didn't have anything, so he didn't put in anything. And so that should be encouraging. Hopefully, that people realize they can actually do something a little bigger and have a higher opportunity.
So the next question is also from Ali. Thank you for all these great questions. Are most self-funded searchers underwriting to 30% net IRR, approximately 3.7x MOIC, to preferred equity investors over 5 years in your experiences? Kind of what are people writing to?
Well, this again, this is one that we can't really, this is an underwriting question, which is not something that was really covered in the study here. What you can see from the study is that the deals are realizing pretty good returns, right? For a large percentage, over 30% IRR. I think generally that just personal experience here outside of the study, I think most searchers, when they go to investors, are shooting for a 30 to 40% IRR, and that's what most investors that we work with are gonna expect. So that's just anecdotal, experience.
That being said, we've seen it higher, right? We've seen people go after that. It depends on the industry. It depends on the business itself. Ultimately, what's beautiful about self-funded search, and one of the reasons that I chose this path instead of going the traditional or accelerator method, was because it enabled me to have the opportunity to find the best terms once I had a deal under letter of intent that I was really excited about. So I know personally my outcome would have been different had I bought in a different industry, in a different business with different historical performance metrics. Same person taking it over. And also there was a way to really illustrate that I did have an ability to come into this business, even though it wasn't from the same industry. It was a similar business model, right? It was professional services. I've been in professional services before. So I think that also gives confidence to equity and debt, right? Equity investors and also debt lenders. And enables you to be more convincing and able to hit your base case, hit your base returns, which gives more confidence in it, which enables you to have it be more kind of in that sweet spot, if that makes sense. So it depends. I hate to say that, but it really just does. And also depends on the size of your equity raise. I mean, there's only so many investors out there. You think about it. Yeah.
Thank you.
So Mark asked about whether you collected any data on geography. Curious about what percentage of searchers acquired basically where they were located. And I do have some data that we did from SearchFunder a while back, but if you have it, I'd love to hear.
So part of this study is, we collected data that is sensitive, right? So all the returns data, for example, we made a commitment to folks when we really started this survey and asked for them to contribute, that we would not be releasing any data at all that could possibly tie them to the study. And so it was done completely anonymously. And on this first initial iteration, decided not to publish any geographical data. That may be something we include in future versions, but in this one we decided not to.
I think there's a way to ask that. We could build something in there down the road of like just asking, did you acquire within 50 miles? Yeah.
Yeah.
So I'm going to put in the chat analysis that we did right before the pandemic in 2020. And that was on distance to your target. So we looked at where the searchers said that they were searching from and where they acquired. And at the time, we found that most searchers acquired a business within either a 1 to 2 hour drive of their search location or a 1 to 2 hour flight from their search location as well,
Wow.
which makes sense because if you're only an hour or two away, it's easier to build a rapport and a relationship with the seller as well. And you probably know the geography a lot better too as well. So I just put that in the chat for you. And then we have a general question about getting started as a search fund entrepreneur. uh, in addition to the required reading, which I will put in the chat, and learning your study, what else would you recommend, Robert and Jordan, for somebody who's getting started in the space?
You can
I
go
would,
first.
yeah, I would really encourage, there's so many good podcasts out there. Karen, I know you put out some great panels. You highlight resources. I mean, that's essentially what we're doing right now, right? Is we're highlighting a resource that somebody can just look up, download, and really hopefully help them kind of structure their search or get excited and make the leap. But podcasts are great. I know that there's several out there that do a great job of highlighting both success stories, but also some warnings and some lessons learned out there. And there's standard books as well. I mean, I know there's like the HBR Guide to Buying a Small Business, and that one really is much more tactical. And there's some other ones that are more fun out there. But ultimately, I think what it comes down to is if you have for this person who's asking the question, if you have a really strong interest in this, just like entrepreneurship generally, you want to do it bad enough, you're going to find a way to do it. And you'll just start absorbing every last possible, YouTube video that you guys put out and podcast and just really envelop in it. And then once you've kind of studied that really well, depending on your career level where you're at, you may want to intern with a search operating company. And then if you go, okay, this is an environment I would love to work in and lead people in, then maybe you want to also intern with a searcher. That's my thoughts there. Robert, go ahead.
No, I think that's right. Network, because you can learn a ton from your network. Get on searchfunder.com and meet other people doing the same thing as you and other people who have done it before you and have been successful at it. And also talk to people who have not been successful at it, so you can get the full picture. But that's what I would say. Don't be afraid to pick up the phone, send emails, get on the phone with people.
Great. And then I'm putting in the chat a link to my site. If you scroll down towards the bottom there, you'll see the required reading list and other resources. So I have a list of all of the podcasts and blogs and all of that on there. So be sure to check that out. Let's see. And the reading list includes what's considered the required reading. So that's highlighted in orange on that page. Let's see.
Conferences. Go to conferences too.
Yes,
That's
yes,
another one.
definitely. If
Yep.
there's one near you, certainly I would highly recommend going. That's where I get to see folks' faces other than in 2D. I get to see them in 3D, which is just absolutely wonderful. So then another general question is about reaching out to investors once you've got a target. Any advice that you have for researchers on that?
Go ahead, Robert.
Well, I'd say that the first thing you should do is call SIG because we can help you with that, but we won't make this an SIG commercial. I think that it's a good thing for you to network and get to know folks in your network, whether that's family, work, high net worth individuals who have invested in other self-funded searches. Start to build that network as you're searching, actually have some early conversations. And then once you have a really good deal under LOI, folks will already kind of know you, and you can contact them and get your equity raised. So
I just my thoughts on this are a little bit different. Maybe it's like due in part the fact that I bought a company in July of 2020, which, if anybody recalls, that's a super fun time to try to build connections with people. But I during my search, I had talked with lots of investors. I went through searchfunder.com, and I pretty much downloaded the list of everybody who says they're an investor. The vast majority of those people did not end up investing in my deal, and I ended up having to scramble under LOI to get my equity raise, which was almost 1.5 million. And hard to say. It's hard to say I should be building deep relationships with investors when they have varying degrees of interest levels in industry or size of company that will only really come out once you actually have a deal to talk about. So that would be the advantage of talking with investors early, is that you can kind of run some of those deals by them and see if they actually would at least indicate that they would invest in your deal. But it's hard to match and understand track records as well. There's a lot of people who want to invest in search, but if you don't do your diligence and properly find out if they have done it before, then you're taking a risk, right, of whether or not they'll actually be there for you. So to me, here's what I would do. I would focus on search. I'd focus on finding good opportunities, diligencing them as fast as you possibly can, moving as swiftly as you possibly can to letter of intent, and staying super proactive. And then when you get to that stage, look, whether you work with us or not, like that's when you need to talk to equity investors. That's what I would do. If I was going to talk, we're going to talk to myself, but it's because you're limited. Your time is very limited. You have one body, and you need to go spend it on the highest and best use, which is, in my opinion, searching. So we have different opinions on that, but they're all good. It's never hurts to build relationships, certainly. So if you can do it all, go for it.
Yeah. So I have one ask of the next survey whenever you do it, and that is to passively ask about mental health and just satisfaction with their acquired company, or if they did not acquire, satisfaction with wherever their career took them from there. So if
That's
you're
awesome.
thinking about the next one, I would love to see that.
It's a great idea, Karen.
Yeah, I love it. Well, we're taking feedback, Karen. So yeah, any other aspects you have, and we really from the community, if anybody else wants to see things in the next iteration, we absolutely want to consider it and make it a part of it, right? So we appreciate everybody who, confidentially, we don't know who they are, we don't know who said what, but we have the aggregated data, and we appreciate everybody for participating in something that hopefully is very helpful to others.
It's incredibly helpful. I think it reaffirmed some of the things that we saw anecdotally, and then there are also those surprises in there, and luckily they were joyful surprises, right? Yeah, which is really nice to have. So we are, I think, past our hour. I am happy to stay on if anybody has general questions about search, life in general, whatever. I'm happy to stay on if you would like. But I want to give a hearty thank you to Jordan and Robert for doing this study. I know it took a lot of work, and then compiling it in an easy to understandable, digestible format, I know took a lot of work. So I appreciate what you've done for the community of searchers, and it's incredibly, I would say, invaluable for anybody who's considering self-funded search. So thank you.
Thank you, Karen. We really appreciate all you do with SearchFunder, and appreciate you having us on today to talk about this.
That's right, Karen. Thank you.
Thank you.
Thanks everybody for joining.